Right now, as you're watching this video, some of the biggest silver dealers in America are quietly filing for bankruptcy protection. And if you don't understand what's happening, you could be caught completely off guard when premiums explode or your orders get canceled without warning. This isn't some conspiracy theory or fear-mongering. This is documented, verifiable, and happening right now in real time. Major institutions that have been moving physical silver for decades are suddenly unable to meet margin requirements that have skyrocketed from reasonable levels to absolutely crushing numbers that would make your head spin. We're talking about margin requirements that have gone from around $3 per ounce to over $22 per ounce in some cases. And that kind of increase doesn't just squeeze profits, it destroys businesses entirely. If you're new here to the gray ledger, we cut through the noise and bring you the real story behind precious metals, finance, and the economic shifts that mainstream media won't touch with a 10-foot pole. Make sure you hit that like button right now and subscribe because this situation is developing fast, and you need to stay informed about what's coming next. The first major crack in the foundation came when TD Bank, yes, one of the largest banks in North America, announced they were exiting the precious metals business entirely. Now, TD Bank didn't just dabble in silver and gold, they were a major player, facilitating massive volumes of transactions for dealers, investors, and institutions across the continent. When a bank of that size suddenly says they're done with precious metals, that's not a casual business decision, that's a red flag the size of a football field. But TD Bank was just the beginning, because shortly after that announcement, whispers started circulating about APMEX, one of the most recognized names in the bullion industry. APMEX has been around for over 2 decades. They've processed billions of dollars in precious metals transactions, and they've built a reputation as a reliable, stable dealer that investors trusted. So when news broke that APMEX was facing serious financial pressure and exploring options including potential bankruptcy protection, people in the precious metals community started paying very close attention. Now let's be clear about what bankruptcy protection actually means in this context, because it's not necessarily the end of a company, but it is a massive warning sign. When a dealer files for bankruptcy protection, they're essentially saying they can't meet their current financial obligations under normal operating conditions, and they need legal protection while they restructure. For customers, this can mean delayed shipments, canceled orders, tied up funds, and in worst case scenarios, complete loss of product that was supposedly purchased and paid for. The question everyone should be asking is this: what changed so dramatically that established dealers with decades of experience are suddenly unable to operate? The answer lies in something most casual investors never even think about: the margin requirements that dealers must maintain when they trade futures contracts to hedge their physical inventory. Here's how it works in simple terms. When a dealer buys physical silver to stock their inventory, they don't just sit on that metal hoping the price goes up. They hedge their position by selling futures contracts, which locks in a price and protects them from losing money if silver prices drop while the metal is sitting in their warehouse. To sell those futures contracts, dealers have to post margin, which is essentially a good faith deposit that proves they can cover potential losses if prices move against them. Under normal market conditions, that margin requirement might be $3 or $4 per ounce of silver, which is manageable for dealers who are moving volume. But when volatility increases, when geopolitical tensions rise, when banking sector stress appears, or when major players exit the market, the exchanges that set these margin requirements get nervous. And when exchanges get nervous, they raise margin requirements to protect themselves, sometimes doubling or even tripling the amount of cash that dealers must keep on hand. This is exactly what happened recently, and it didn't happen gradually, it happened fast. Margin requirements on silver futures shot up to levels that many dealers simply could not sustain without massive injections of capital. We're not talking about a 10 or 20% increase here, we're talking about requirements that went from around $3 to over $22 per ounce in certain contract months. Do the math on that. If a dealer is hedging 10,000 ounces of physical silver, their margin requirement just went from $30,000 to $220,000 almost overnight. That's $190,000 in additional capital that has to be pulled from somewhere immediately, or the dealer faces margin calls and potential forced liquidation of positions. Most dealers operate on relatively thin margins to begin with. They make their money on volume and on the premium spread between what they pay and what they sell for. When you suddenly need to come up with hundreds of thousands or even millions of additional dollars just to maintain your existing hedges, that's not a profit problem anymore. That's an existential crisis. And this is where the domino effect starts, because when one major dealer runs into trouble, it creates supply disruptions that affect the entire market. When dealers can't maintain their margin requirements, they have a few options. And none of them are good for the market or for customers who are trying to buy physical silver. Option 1 is they stop taking new orders entirely, which means inventory that might be sitting in their warehouse becomes unavailable to the market even though it physically exists. Option 2 is they liquidate their futures positions, which can create additional selling pressure in the futures market and potentially drive prices lower, at least temporarily. Option 3 is they raise premiums dramatically to reduce order volume and generate enough cash flow to meet margin calls, which is exactly what we've been seeing across the industry. And option 4, the nuclear option, is they file for bankruptcy protection and try to restructure their entire business model while customers wait in limbo, wondering if they'll ever see their metal or their money. Now, let's talk specifically about what happened with APMEX, because this is where the story gets really interesting and really concerning. Reports emerged that APMEX was dealing with a severe liquidity crisis, meaning they had assets, they had inventory, but they didn't have enough cash on hand to meet immediate obligations. This is the classic definition of a liquidity crunch, and it's particularly dangerous in the precious metals business, where customer trust is absolutely everything. When word got out that APMEX might be in trouble, customers who had pending orders started panicking, calling customer service, demanding answers about when their metal would ship. Some customers reported waiting months for delivery on orders that had already been paid for in full, which is completely unacceptable under normal circumstances. Others reported that their orders were simply canceled without adequate explanation, with refunds issued instead of the physical metal they had purchased at lower prices. Imagine you bought silver at $18 an ounce, you paid in full, you waited patiently, and then weeks or months later you get a refund while silver is now trading at $28 or $30. You didn't just miss out on delivery, you missed out on significant gains. And now you have to buy back in at much higher prices if you still want to own physical metal. This is the real-world impact of these dealer liquidity crises, and it's affecting regular investors who are just trying to protect their wealth and diversify their portfolios. Now, APMEX isn't the only dealer facing these challenges. Industry insiders report that multiple mid-sized and even some larger dealers are struggling with the exact same margin pressure. The difference is that most of these dealers are staying quiet, tightening their operations, raising premiums, and hoping they can ride out the storm without publicly admitting financial distress. But here's what you need to understand. This isn't just about individual dealers making bad business decisions or being poorly managed. This is a systemic issue driven by forces much larger than any single company, forces that are fundamentally changing how the physical silver market operates. The explosion in margin requirements didn't happen in a vacuum. It happened because the silver market itself has become increasingly volatile and increasingly disconnected from normal supply and demand fundamentals. We've got central banks around the world buying gold at record levels. We've got inflation running hotter than official numbers suggest. We've got geopolitical tensions that seem to escalate every other week. We've got a banking crisis that went from zero to Silicon Valley Bank collapsing in a matter of days. And we've got currency instability that has investors fleeing to hard assets. All of these factors contribute to volatility in precious metals markets, and volatility is the number one driver of margin requirement increases. The exchanges that set these margin requirements, places like the COMEX, are essentially trying to protect themselves from catastrophic losses if prices move dramatically in either direction. Their job is risk management, not supporting the precious metals dealer industry, so when they see increased volatility, they raise requirements without much concern for who it might put out of business. From their perspective, it's better to have a few dealers fail than to have the entire exchange face systemic risk from under-margin positions that can't be covered. But for the dealers caught in this squeeze, and for the customers who rely on those dealers, this creates absolute chaos in the market. And here's where it gets even more interesting, because some analysts believe this margin pressure is not entirely organic or coincidental. There's a theory, and it's worth considering even if you don't fully buy into it, that certain large institutional players benefit from squeezing smaller dealers out of the market. If you can drive up margin requirements to levels that only the biggest, most well-capitalized dealers can sustain, you effectively consolidate the market into fewer hands. Fewer competitors means more control over pricing, over premiums, over supply flow, and ultimately over the physical metal that reaches retail investors. Now, whether this is intentional market manipulation or just the natural result of increased volatility and risk management is something reasonable people can debate. But what's not debatable is the outcome, which is that smaller and mid-sized dealers are getting crushed while larger institutional players with deep pockets are weathering the storm. Let's talk about the inventory data, because this is where we can see concrete evidence of what's happening in the physical market right now. Dealer inventories of physical silver have been declining steadily over the past several months, and this isn't because demand has dropped off, it's actually the opposite. Demand for physical silver remains extremely strong, especially from investors who are worried about banking stability, currency debasement, and the overall direction of the economy. But available inventory keeps shrinking, which tells you that either production isn't keeping up with demand, or dealers can't afford to stock the inventory they need because of margin pressures, or both. When you look at the publicly available data from major mints around the world, you see production numbers that are healthy, Silver is being mined, it's being refined, and it's being minted into coins and bars. But somewhere between production and the retail investor, there's a bottleneck, and that bottleneck is the dealer network that's currently under massive financial stress. If dealers can't maintain adequate inventory because they can't afford the margin requirements to hedge that inventory, then it doesn't matter how much silver is being produced at the mine level. The metal doesn't flow efficiently to the end buyers, which creates artificial scarcity in the retail market, even when there's no actual shortage at the production level. This is a crucial distinction that a lot of people miss when they're trying to understand why premiums are so high right now. It's not necessarily that there's no silver available anywhere in the world, it is that the distribution system that gets that silver from producers to your doorstep is breaking down under financial pressure. And when distribution breaks down, premiums go up. Because the dealers who are still operating and still able to source metal can charge whatever the market will bear. We've seen premiums on popular products like American Silver Eagles go from $2 or $3 over spot to $6, $8, even $10 over spot, depending on the dealer and the availability. Those kinds of premiums aren't just profit-taking. They're a reflection of genuine supply constraints at the dealer level and the increased cost of doing business in this volatile environment. For investors who are trying to accumulate physical silver, this creates a really frustrating situation where you're paying significantly more per ounce than you would have just a year or two ago. And the question becomes, are these elevated premiums the new normal? Or is this a temporary situation that will resolve once market conditions stabilize? Based on what we're seeing with dealer bankruptcies and margin pressures, it's looking more and more like higher premiums are here to stay, at least in the medium term. Because even if margin requirements eventually come back down, the damage to the dealer network has already been done. And rebuilding that network takes time and capital. Dealers who went bankrupt aren't coming back. Dealers who barely survived are going to be extremely cautious about expanding inventory, and new dealers are not going to rush into a market that just proved how dangerous it can be. This creates a supply-constrained environment that favors the dealers who remain, which means they have pricing power, which means premiums stay elevated. Now let us talk about what this means for you as an investor or someone who's considering getting into physical silver. First, and most obvious, if you've been sitting on the fence waiting for premiums to come back down before you start buying, you might be waiting a very long time. The market conditions that are driving these dealer crises aren't going away anytime soon. And in fact, many of them are likely to get worse before they get better. Banking sector stress isn't resolved, inflation isn't under control, geopolitical tensions are escalating, and central bank money printing continues despite rhetoric about tightening. All of those factors support continued volatility in precious metals, which means continued high margin requirements, which means continued pressure on dealers. Second, you need to be extremely careful about which dealers you're buying from, because not all dealers are created equal in this environment. The dealers who are most at risk are the ones operating on thin margins, carrying large inventories, and without access to substantial capital reserves. Before you place a large order with any dealer, do your homework, check their reputation, look for recent customer reviews, see if there are any red flags about delayed shipments or canceled orders. It's better to pay slightly higher premiums to a dealer you're confident will actually deliver your metal than to save a few dollars with a dealer who might file bankruptcy before your order ships. Third, consider diversifying not just your metals holdings, but also your dealer relationships. Don't put all your eggs in one basket with a single dealer. If you're making substantial purchases over time, spread those purchases across multiple reputable dealers so that if one runs into trouble, you're not completely exposed. And fourth, understand that in this environment, patience might not be rewarded the way it has been in the past. There's a common strategy among silver investors to wait for dips in spot price before making purchases, and that can be a smart approach under normal market conditions. But when you've got systemic stress in the dealer network and genuine supply constraints developing, waiting for the perfect entry point might mean missing the opportunity to buy physical metal at all. We are already seeing situations where dealers are sold out of popular products even when spot prices are relatively stable, which tells you that price isn't the only factor driving availability anymore. Scarcity is becoming a real issue, not manufactured scarcity for marketing purposes, but genuine scarcity driven by the breakdown of normal distribution channels. Now, some of you watching this might be thinking, okay, this sounds bad, but is this really proof of a coming silver shortage, or is this just normal market volatility? That's a fair question, and the honest answer is that it depends on how you define shortage. If you define shortage as literally zero silver available anywhere at any price, then no, we're not there and we probably won't get there. But if you define shortage as significant difficulty obtaining physical metal at reasonable prices through normal retail channels, then yes, we're already in the early stages of that kind of shortage. The key indicator is the growing disconnect between paper silver prices on the futures exchanges and the actual cost of obtaining physical metal in your hands. When premiums are $2 or $3 over spot, that's normal. That's the cost of fabrication, distribution, and dealer markup. But when premiums are $8, $10, $12 over spot, that's telling you something fundamental has changed in the supply-demand equation. It's telling you that there are more people who want to own physical silver than there is easily accessible physical silver available through normal retail channels. And when dealer bankruptcies remove even more capacity from the market, that imbalance gets worse, not better, which pushes premiums even higher. This creates a feedback loop where high premiums reduce the number of casual buyers, but the serious buyers who understand what's happening become even more motivated to acquire metal while it's still available. Let me give you a real-world example of how this plays out. Let's say you're a dealer who survived the initial margin squeeze and you're still operating. You look around and you see that several of your competitors have either gone bankrupt or severely curtailed their operations, which means there's less competition for customers. At the same time, your own costs have gone up, because margin requirements are still elevated and your cost of capital has increased. So you make a business decision to raise your premiums, not because you're greedy, but because you need to generate enough cash flow to stay solvent in this environment. Your customers complain about the high premiums, but they still buy because they recognize that buying at $8 over spot today might look brilliant 6 months from now if premiums go to $15 over spot. And this is exactly the dynamic we're seeing play out across the industry right now. Premiums keep climbing, customers keep complaining, but metal keeps selling because people understand the alternative might be not being able to buy at all. The situation with John A.G. and his coverage of this liquidity crisis has been particularly valuable because he's been documenting the real-world impacts on actual dealers and actual customers. These aren't theoretical problems or predictions about what might happen someday. These are current, ongoing situations where people as money and people as orders are tied up in dealers who can't fulfill their obligations. When you hear directly from customers who've been waiting months for delivery, or who've had six-figure orders canceled, or who can't get straight answers from customer service, that's when the severity of this situation really hits home. This isn't just about market dynamics and margin requirements. This is about real people who saved their hard-earned money and tried to protect their wealth by buying physical silver, only to get caught in a system that's breaking down. And here's what makes it even more concerning. The mainstream financial media is almost completely ignoring this story. You're not seeing headlines on CNBC about silver dealer bankruptcies. You're not seeing in-depth analysis on Bloomberg about the margin crisis in precious metals. The coverage that does exist is usually brief, technical, and buried in the business section where most people will never see it. This is why channels like the Gray Ledger exist, to bring you the stories and the analysis that you won't get from mainstream sources, who are either unaware or uninterested in what's happening in the precious metals market. If you found this information valuable, if it helped you understand what's really going on with silver dealers and why premiums are so high, do me a favor and drop a comment below. Tell me if you've experienced delays or cancellations with dealers, share your thoughts on where the situation is headed, and let me know if you want more deep dives like this on precious metals markets. And please, hit that share button and send this to anyone you know who's invested in silver or thinking about it, because this is information that could literally save people from losing money or missing opportunities. The reality is that we're watching a fundamental restructuring of how physical precious metals are distributed in North America, and most investors have no idea it's even happening. The dealers who survive this crisis are going to emerge with significantly more market power, which means less competition, which typically means higher prices for consumers. The dealers who do not survive are going to leave behind a lot of unhappy customers and a lot of cautionary tales about the risks of doing business with undercapitalized operations. And the investors who understand what's happening right now have a window of opportunity to make decisions before this situation gets even worse. Because here's the thing that should really concern you, everything we've talked about in this video. The margin pressures, the dealer bankruptcies, the supply constraints, all of this is happening while silver prices are still relatively subdued compared to historical highs. Imagine what happens if we get a real crisis, a genuine breakdown in confidence in the US dollar, or a major geopolitical event that sends investors flooding into precious metals all at once. If the dealer network is already stressed to the breaking point under current conditions, what happens when demand suddenly doubles or triples? The system doesn't just get strained, it potentially breaks completely. And you end up with situations where physical metal simply isn't available at any price, because there's no functioning distribution network to deliver it. This is why some of the smartest investors in the precious metals space have been accumulating physical silver consistently over time, not trying to time the market perfectly, but simply building positions while metal is still available. They understand that the greatest risk isn't overpaying by a few dollars per ounce in premiums. The greatest risk is not having any physical metal at all when you finally decide you want it. The silver market has always been smaller and more volatile than the gold market, which makes it more susceptible to these kinds of supply disruptions and dealer crises. When you're dealing with a market where total above-ground investment grade silver is measured in billions of ounces, not trillions, it doesn't take much to create genuine scarcity. And when you layer on top of that the industrial demand for silver in electronics, solar panels, medical applications, and emerging technologies, you've got a metal that's being pulled in multiple directions simultaneously. The dealers who are going bankrupt right now aren't failing because silver is worthless or because demand has disappeared. They're failing because of the financial infrastructure that supports physical metal distribution is under unprecedented stress. This is a crucial point that bears repeating. The fundamentals for silver remain strong. Industrial demand is growing. Investment demand is solid. Mine production is relatively flat. And central bank policies continue to debase fiat currencies. What's breaking isn't the case for owning silver. What's breaking is the system that allows regular investors to easily convert their dollars into physical metal. So as we wrap up here, let me leave you with a few final thoughts on how to navigate this environment. Stay informed, pay attention to which dealers are having problems, watch for warning signs like suddenly increased delivery times or dramatic changes in premium structures. Be selective, work with established dealers who have strong balance sheets and good reputations, even if their prices are slightly higher. Be realistic. Understand that the days of buying silver at tiny premiums over spot are probably gone for the foreseeable future, and adjust your expectations accordingly. And be strategic if you believe in the case for owning physical silver, and the fundamentals certainly support that case. Then focus on accumulating metal while it's still available rather than trying to optimize every purchase for the absolute lowest price. The margin crisis that is crushing silver dealers right now is a symptom of much larger problems in the financial system, and those problems aren't going away just because we stop talking about them. This is The Gray Ledger, bringing you the real story behind the markets, and I'll see you in the next one.